For a long time, the system has been described as resilient. Reports have pointed to steady growth curves, manageable debt ratios, controlled inflation bands. Central institutions have repeated a quiet reassurance. The mechanisms are understood, the risks are modelled, the safeguards are in place. Stability in this framing is not an accident, but an achievement. It is often in such moments that systems become most difficult to read, because stability, when observed closely, is rarely a still condition. It is a continuous process of adjustment, of small imbalances being corrected before they widen. The appearance of calm depends on countless underlying movements remaining synchronized. When they drift, even slightly, the surface can remain smooth for some time, long enough, in fact, for confidence to deepen. There is a pattern that appears repeatedly in economic history. It does not begin with collapse. It begins with consensus, a shared belief that the structure has matured beyond its earlier vulnerabilities, that the lessons of past crises have been absorbed and encoded into better policy, better tools, better oversight. Each generation inherits this belief, often strengthened by recent success. In the early 20th century, financial systems were said to have reached a new level of sophistication. By the mid-century, post-war institutions were considered stabilizing forces strong enough to prevent another global depression. At the turn of the 21st century, advanced risk modeling and interconnected markets were described as buffers against large-scale shocks. Each time the reasoning was not entirely wrong. Systems did evolve, mechanisms did improve. But alongside those improvements, something else emerged, something less visible. Complexity increased, not in a way that was immediately dangerous, but in a way that made the system harder to interpret. Layers of interdependence formed between markets, institutions, and policies. A disturbance in one area no longer remained isolated. It travelled, sometimes slowly, sometimes in ways that were difficult to trace. Confidence, however, did not diminish in response to this complexity. It adapted. It became more abstract. Instead of trusting individual components, the system began to trust its own scale. Its size, its reach, its integration became arguments for its stability. This is where a quiet shift tends to occur. When stability is assumed, the tolerance for imbalance increases. Small inefficiencies are accepted. Then, slightly larger ones. Not because they are ignored, but because they appear manageable within the broader structure. The system, after all, is large. It can absorb fluctuations. Over time, what was once considered an exception begins to resemble a norm. The mechanisms designed to stabilize the system start to carry a different kind of weight. They are no longer only correcting imbalances. They are sustaining conditions that might otherwise adjust on their own. This is not done abruptly. It happens gradually, often under the justification of maintaining continuity. The language used to describe these actions remains careful. Terms like support, liquidity, and temporary measures are repeated. They suggest control, not dependency. And yet, beneath this language, the structure begins to rely on these interventions in ways that are not immediately obvious. The system still appears stable. Indicators still fall within acceptable ranges. Growth continues, though sometimes unevenly. Markets adjust, recover, and move forward again. From a distance, there is little to suggest that anything fundamental has changed. But if one looks closely, a different pattern begins to emerge. The margin for error narrows. Not dramatically, not in a way that triggers alarm, but incrementally. The system becomes more sensitive to disruptions, even as it appears more robust. This sensitivity is not always visible in standard measures. It reveals itself in how quickly interventions are required, how frequently they are deployed, and how large they must be to achieve the same effect. At this stage, the system does not feel fragile. It feels maintained. And maintenance, when sustained over long periods, can be mistaken for strength. The distinction between the two is subtle, but it has defined the trajectory of many systems before this one. What matters is not whether the system can continue under these conditions for a few more years. History suggests that it often can. What matters is how these conditions accumulate, how they interact, and how they reshape the underlying structure in ways that are not immediately visible. Because by the time instability becomes obvious, it is no longer forming. It has already taken shape. The structure that supports a financial system is rarely built on a single foundation. It rests instead on a network of commitments, expectations, and flows that reinforce one another over time. These flows are not limited to money itself, but include confidence, credibility, and the assumption that obligations will continue to be met without interruption. What becomes visible when examined over long periods is that funding systems tend to follow a recurring pattern. They begin with constraints. Resources are limited, risks are closely monitored, and expansion is cautious. Growth, when it occurs, is tied directly to underlying productivity or tangible output. But constraints, while stabilizing, also limit expansion. As economies grow more complex, the demand for flexibility increases. New mechanisms are introduced to allow capital to move more freely, to respond more quickly, to support larger scales of activity. Credit becomes more accessible. Instruments are developed to distribute risk across broader networks. At first, these changes appear as improvements, and in many ways, they are. Access to capital expands. Innovation accelerates. Systems become more dynamic, less restricted by the rigid boundaries that once defined them. The ability to smooth over short-term disruptions improves. Where earlier systems might have contracted sharply under stress, more flexible systems can absorb and redistribute pressure. This is the phase where the structure begins to shift in ways that are not immediately recognized as structural. Because flexibility, once introduced, tends to extend beyond its original purpose. The boundaries that once limited expansion begin to loosen. Credit is no longer tied as tightly to underlying output. It becomes influenced by expectations of future growth, by projections, by models that assume continuity. The system begins to fund not only what exists, but what is anticipated. This is not inherently unstable. In fact, it often produces periods of sustained growth. But it introduces a subtle dependency. The system begins to rely on the continuation of conditions that justify those expectations. Growth must continue, or at least appear to. Confidence must be maintained. The mechanisms that support expansion become intertwined with the outcomes they are meant to facilitate. Historical examples reveal this pattern with quiet consistency. In the decades leading up to major financial dislocations, there is often an expansion of credit relative to underlying production. Not abruptly, but steadily. Debt accumulates across different layers of the system: households, corporations, governments, each responding to the same underlying environment of accessible capital. This accumulation is rarely viewed as a singular risk. It is distributed, diversified, embedded within institutions that appear stable. Risk models account for known variables, stress scenarios are constructed, safeguards are implemented. And yet, the system as a whole begins to carry a larger obligation, not just in absolute terms, but in relation to its ability to service that obligation without continuous support. This is where funding systems reveal their deeper structure. They are not static. they evolve in response to pressures. When growth slows, mechanisms are introduced to sustain activity. Interest rates may adjust, liquidity may be provided, interventions may occur to prevent contraction from spreading. Each of these actions, taken individually, appears rational, necessary even. But collectively, they begin to alter the system's baseline. What was once considered extraordinary becomes normalized. Interventions that were previously reserved for periods of acute stress are used more frequently, sometimes preemptively. The system adapts to their presence. Over time, a new equilibrium forms. In this equilibrium, the system functions effectively, but under conditions that require ongoing support. The distinction between temporary measures and permanent structures becomes less clear. Policies designed to stabilize begin to shape the environment in which the system operates. The result is not immediate instability. It is a reconfiguration. The system becomes more capable of sustaining activity in the short term, but more dependent on specific conditions being maintained. These conditions include low volatility, predictable policy responses, and continued access to liquidity. The trade-off is subtle. Stability is preserved in the present, but flexibility in the future is reduced. The system's ability to adjust organically, to contract where necessary, to reallocate resources without intervention, becomes constrained. This constraint is not always visible in conventional indicators. Markets may continue to function. Growth may persist. Even shocks, when they occur, may be absorbed with relative efficiency. But each response requires a certain alignment of factors. When those factors are present, the system appears resilient. When they begin to diverge, the responses become more complex. What history shows is that funding systems, once they reach this stage, do not fail because of a single cause. They reach a point where multiple pressures converge. Credit levels that once seemed manageable become more sensitive to changes in conditions. Interest rates, even when adjusted carefully, have broader effects than before. Liquidity, while available, must be deployed in larger quantities to achieve the same stabilizing effect. The system does not collapse under these pressures immediately. It continues to function, often for extended periods, but its behavior changes. It becomes more reactive, more reliant on coordination between institutions, more sensitive to shifts in confidence. And confidence, unlike capital, is not evenly distributed. It moves quickly, sometimes without clear cause, sometimes in response to signals that are not fully understood at the time. When confidence begins to shift, the structures that depend on it are tested, not all at once, but in sequence. The pattern is not dramatic, it is methodical. And by the time it becomes widely recognized, the underlying conditions have already been in place for some time. What distinguishes these moments from ordinary cycles is not the presence of strain, but the timing of recognition. Systems rarely announce their turning points. They continue to operate, to settle transactions, to produce output, even as the conditions that support them begin to shift beneath the surface. The transition is often described, in hindsight, as sudden, but this description belongs more to perception than to reality. In practice, the shift unfolds across layers. At the institutional level, responses begin to change in tone. Measures that were once preventative become reactive. Interventions are introduced more quickly, sometimes before the full scope of a problem is understood. This is not a sign of mismanagement, but of sensitivity. The system has reached a state where delays carry greater consequences than before. At the same time, signals begin to diverge. Indicators that once moved together start to separate. Growth may persist in one sector while contracting in another. Markets may rise even as underlying conditions weaken. Data becomes more difficult to interpret, not because it is inaccurate, but because it reflects a system no longer moving in unison. This divergence creates a particular kind of uncertainty, not the kind that leads to immediate withdrawal, but the kind that causes hesitation. Decisions are delayed, commitments are reconsidered. Institutions, aware of their interdependence, begin to assess not only their own position, but the stability of those around them. It is in this environment that funding systems reveal their final characteristic. They depend on continuity. As long as obligations can be rolled forward, as long as liquidity can be accessed, as long as confidence holds, the system can sustain itself. It does not require perfect conditions, only sufficiently stable ones. But when continuity is interrupted, even briefly, the structure is exposed. This interruption does not need to be large. A shift in rates beyond expected ranges, a reduction in available liquidity, a reassessment of risk that spreads faster than anticipated. Any of these can act as a catalyst, not because they are unprecedented, but because they occur within a system that has less room to absorb them. When this happens, the response is rarely uniform. Some parts of the system adjust quickly, others lag. The coordination that once appeared seamless begins to strain. Institutions act to preserve their own stability, which can, in aggregate, reduce the stability of the system as a whole. This is not a failure of intent. It is a structural outcome. Because the system, in its evolved state, has become more interconnected, actions that are rational at the individual level can produce unintended effects collectively. Liquidity withdrawn in one area creates pressure in another. Risk reduced in one sector increases it elsewhere. The adjustments that follow are not immediate corrections. They are sequences. Assets are repriced. Funding conditions tighten. Access to capital becomes more selective. These changes do not occur all at once, but they move through the system with a certain consistency. Each adjustment reveals another layer of dependency, another area where conditions were assumed to be stable. For individuals, these shifts are experienced indirectly at first. Costs begin to change. Opportunities narrow. Decisions that once seemed routine require more consideration. The system does not appear to have collapsed. It continues to function, but it does so under different constraints. Over time, these constraints become more visible. Institutions revise their expectations. Policies adjust, sometimes in ways that reflect trade-offs that were previously avoided. The balance between stability and flexibility, which had been managed quietly for years, becomes more difficult to maintain. It is at this stage that the narrative often turns toward causes. Analyses focus on specific events, decisions, or actors. And while these factors may have contributed, they rarely explain the full trajectory. The conditions that made the shift possible were established long before the triggering moment. What matters, from a historical perspective, is not the exact timing of such transitions. It is the recognition that systems evolve toward them, not intentionally, not predictably, but through the accumulation of choices that favor stability in the present over flexibility in the future. Each choice, taken alone, appears reasonable. Together, they form a structure that behaves differently under stress. By the time this difference becomes clear, the system is already adapting. New equilibria begin to form. Some institutions strengthen, others contract. Policies are rewritten, sometimes quietly, sometimes with acknowledgement of changing realities. The system does not disappear, it reconfigures. And in that reconfiguration, the assumptions that once defined stability are reconsidered. The period that follows is not defined by collapse, but by adjustment. A recognition, gradual and uneven, that the conditions which supported one phase of growth are no longer sufficient for the next. That continuity, once taken for granted, must now be actively maintained under different constraints. This is how funding systems change, not with a single event, but with a shift in what is required to keep them functioning. And by the time this shift is fully understood, it is no longer approaching. It has